Earlier this week, HousingWire hosted a virtual economic summit, which we creatively named the Housing Market Update. The goal here is to equip our audience with the insights and data that you need to win in 2023. Whatever that means for you, if you want to win market share, recruit more LOs, manage a better servicing book, make better investments, or just have better talking points and insights to share with your referral partners, clients, and prospects, that's the lens that we're taking here. Before I introduce the guests, I want to give a big thank you to Salesforce for sponsoring the virtual event, which initially aired on Monday. I've taken the time to comb through that 90-minute session several times, and I pulled out the most salient and relevant and important talking points and data points from the housing market update to share with you, our housing news audience. So if you want to check out the full 90-minute session and see the video content, which includes some charts and video of our guests, the link to that is going to be available in the show notes. So I encourage you to check it out if you want to go a layer deeper. The guest for the HousingWire or the housing market update includes some of the most important thinkers and analysts and economists in the housing industry. So we start off with Logan Mohtashami, the lead analyst for HousingWire, Lisa Sturtevant, the chief economist at Bright MLS, Mike Simonsen, the president of Altos Research, Odeta Kushi, VP and deputy chief economist at First American, and Geoff Green, the global head of mortgage and lending at Salesforce. So now we're going to jump into the content. Our first speaker that we're going to highlight in this housing news special edition is Lisa Sturtevant. Lisa kicks us off with some really important points. She highlights that before we focus on what's ahead for 2023, we need to be on the same page about what really played out in the housing market in 2022. Lisa has a great reminder. If someone tells you they know for sure what is going to happen in 2023, you should take that with a grain of salt.
And just starting, I know that, we want to look ahead, but it's always helpful to look back just for a little bit. And we do know that 2022 was really a tale of two markets, right? The first half of the year, we saw home sales activity as brisk as it had been really in 2022. In 2021, we saw prices still rising at double-digit rates. We saw very competitive housing market with multiple offers over list. And then bam, it was like a switch got flicked in July, and there's a sort of whiplash as the market did an about face. And we saw that in the second half of the year, and this chart shows home sales, US home sales on a monthly basis. Home sales activity really looked more like 2014 or 2015 than it did like 2019. I mean, and we know the reasons, right? The story has been well told. As inflation was rising and the Federal Reserve was hiking short-term interest rates, we saw mortgage rates escalate faster than they have in 4 decades. And rising mortgage rates, of course, really took a big bite out of home buyers' purchasing power, and they started to sit on the sidelines. But I think what gets missed sometimes in the characterization of the last half of last year was it wasn't just home buyers pulling back, but it was also sellers pulling back. So one way in which I think we sort of have to think about where 2023 is going and maybe how to dispel some of maybe the myths of what the market might look like as it's adjusting. Understanding that both buyers and sellers sort of retreated from the market is really important.
Now that Lisa has set the stage for 2023, she jumps into her viewpoints for next year. She talks about some of the phrases that are being used around a potential housing market recession versus the term a housing market reset. Lisa does reference some charts here. So if you want to check out the video, the link is available in the show notes, as I mentioned earlier.
And, so I do think that instead of talking about a housing market recession in 2023, which there are still some people out there who are saying that the market is, getting set for collapse and that prices are going to come down. I don't know that there's really any reason to think of 2023 as a housing recession, but rather as a housing resetting. And so what we're doing is we're hearing all sorts of information come out about what's going on in the market. And we have to remind ourselves that the last couple of years have not been a typical housing market, right? And so if you've only been in the market for the last 2 or 3 years, it's hard to remember what typical might be. So for an example, we have seen that median price Prices, for example, have come down from their peak levels. So you can see the orange line in 2022. You can see that home prices peaked in June. And since then, over the next 6 months, prices came down. We didn't see that in 2021 or even in 2020. But that is a typical pattern of prices peaking in the summer and then starting to come down slowly in the second half of the year. We saw that in 2018. We saw that in 2019. So again, sort of resetting what we would expect a market to do is going to be really important as we head into 2023. I will say, though, the downturn in prices from the peak is sharper in 2022 than it had been in either 18 or 19. But it is what happens, right? It is what's typical. And as we talk to prospective buyers and sellers, and as real estate professionals work with consumers in the marketplace, sort of reminding folks that there's a seasonality to the housing market, that there are these patterns that happen throughout the year, that we basically, lost that seasonality during the pandemic-fueled housing market. There are a lot of folks who are seeing some of these, downturn in home prices, the pullback in buyers, and are raising concerns that we are set for another big crash like we had in 2006 and 2007, and creating a lot of anxiety, frankly, for folks who might want to be in the market. But there are a lot of reasons to remind ourselves that the current market is just very, very different than what we had 15 years ago. And if you were working in the housing market back in 2004 through 2008, it might be hard to not think about that time when we think about a market slowing now. But as I mentioned, the situation is really very different. We have very low inventory in the housing market now compared to a lot of new construction, a lot of inventory expanding back in 2008. Now, of course, we have virtually no subprime lending in the market, where subprime lending was really fueling housing market activity back in the last run-up. We have very low foreclosures. Again, another piece of information that's helpful to remember as we're resetting expectations, because we've heard foreclosure rates doubling, for example. But the foreclosure rate may have doubled over the last year, but it was at zero a year ago. And double of zero is still pretty much zero. And so we are still actually at a foreclosure rate that's lower than long-term averages. Again, resetting expectations. What should the market look like? We have a very resilient labor market. The most recent jobs numbers came out on Friday, showing that we added over 500,000 jobs between December and January. Labor market sort of defying expectations as the Federal Reserve has raised rates. We've seen the labor market stay really resilient. And while prices have been up at double-digit rates, we had prices up 50% in 1 year back in 2008. We sort of had a much different market. So there's really 5 things I think that people that are sort of going on in this housing market reset. And the first is rates. We're seeing that 6% is the new normal, and we're not going back to 3%. We have been seeing in our market in the Mid-Atlantic that when rates started to come down in January, showings were up. New purchase contracts were up. People are sick of sitting on the sidelines and are willing to come in and accept 6% as the new normal in terms of rates. Sellers need to adjust their price expectations, though. We're finding that sellers who are pricing their homes appropriately to this market are still finding really eager buyers. But it's sort of like the 5 stages of grief, right? They're depressed that they're not getting what their neighbor got. They're angry about the situation. And now I think we've come to acceptance where as folks are understanding the new market and pricing homes appropriately, they will expect that buyers are going to have more leverage, not only on price, but also on concessions. We saw during the pandemic in our market, less than a fifth of all transactions had a seller concession. Usually it's around 50 or 60%, and we're headed back in that direction. As much as we hear about inventory expanding and growing 50, 60% year over year, remember when you start at a really low level, 50% increase is still really low, and we will expect inventory to stay pretty low in 2023.
Our next speaker is Mike Simonsen, president of Altos Research. Altos tracks every home for sale in the country every week. All the supply, all the demand, all the prices, all the pendings, and all the changes in that data. It's pretty phenomenal. Mike and the Altos clients leverage this data to understand local, regional, and national housing market trends at essentially a real-time speed. Mike kicks off his talk today with sharing that there are only 457,000 single-family homes on the market in the US. So inventory fell by almost 2% last week. And while inventory is currently higher than last year, it's incredibly low historically. It's not uncommon that in the first week of February, we see an absolute low point in inventory. And we often see it start climbing as the weeks move on in February. But in some years, like in 2021, we didn't see inventory bottom out until the end of April before a May rebound. Mike also talks about the demand side of the equation and how he looks at pending home sales as a forward indicator. We're at 279,000 single-family homes under contract right now, and that's significantly lower than last year. Mike's analysis gets really interesting when he talks about the change we're seeing this quarter in comparison to Q3 and Q4 2022. Here's Mike Simonsen.
But it's also notably different from the last two quarters. So September, October, November, December, when the sales volume was dropping very dramatically all the way through. You can see how the chart drops all the way through the second half of 2022 here, before is now rebounding. And so the sales volume this is encouraging in a robustness sense. And what we're finding is that the demand or the supply is sufficiently low, demand is sufficiently high to keep a floor on pricing. So we aren't, there's no signals in the data of significant prices falling significantly in the rest of the year. There's also, of course, no signal of significant price appreciation this year, but there is sufficient demand in the market right now to keep a floor on any further prices declining. And here's another way we can look at a leading indicator of where sales prices will be in the future. And what we do is when we watch every home for sale in the country, we can track the percentage of homes on the market that have taken a price cut. And these are homes that are listed in December. And if they didn't get an offer now in January, they take a price cut, they get an offer in February, that deal closes in March or April. So those are sales data that are going to happen in March, April, and you might not even hear about it until May. But what we can see is exactly where the demand is right now. And in a normal market, you can think of about 30%, about a third of homes take a price cut before they sell. Sometimes that's strategic overpriced. Sometimes it's a crazy, seller who wants too much and wants to test the market. And in a hot market, so a third normally are overpriced. And in a hot market, fewer than that have to take a price cut because that crazy seller gets the offers. And then as the market cools, now it's 35, 40, 45%. In 2008 and 9, it was maybe 50% of the market across the country had taken a price cut. And so what we can see here is each line here is a year, the curve that happens in a year. And the light red line is last year, started the year, record few price reductions. And then starting in the middle of March, price reductions started creeping back into the market. You can see it deviating from the 2021, the year before, and then dramatically rising in the second quarter. This was demand cooling. And the other thing you can see here is the second week of September last year, price reductions were flat and then they started climbing again. That was the moment that mortgage rates jumped from 5.5% to 6.5% to 7.5%. And you can see it immediately in the data by watching the price reductions. And so what do we see right now? We see now 5 weeks into 2023, we can see dramatically fewer. Not dramatically. We can see a nice steep decline in price reductions each week. That's because the buyers are in the market. These are homes that maybe took a price cut in December. Now they get offers. They're off the market. They're they're being sold. And so there are fewer and fewer of those that on the market that are taking a price cut. This week, 33% of the U.S. has the homes on the market in the U.S. have had a price cut, and that's falling. It was 33.9% last week, and it is right in the middle of what we might call a normal range. And you can see there's a seasonal pattern. So there's in the spring, there's fresh new inventory. It doesn't take a price cut until later if it doesn't get offers. And so in the second and third quarter, price reductions rise again. But what we can see is that the demand is starting to gobble up the homes that sat around in the fourth quarter. And so those are now getting offers. And we can see that this implies that the transactions that happen in the future have a level of price support. If we were, on the other hand, this winter and spring, we're at this moment and we're seeing price declines stay around 40% or even tick up, that would be telling us that there was a continuation of the cold demand of the fourth quarter, and we're just not seeing it. So there's no indication in the data anywhere right now that the transaction prices of the future, like that there are any dramatic price declines in the traditional numbers, the lagging traditional sales numbers, which will come out in several months. There's no indication of those are going to tick down dramatically this year. It really looks like a flat year over year home price. At least all the leading indicators look like flat year over year, 2023, by the end of 2023 over 2022.
Our next speaker is Odeta Kushi, VP and Deputy Chief Economist at First American. Odeta is really helping us build a full market view. Lisa gave us a glimpse into the market action in 2022 and her view of the reset happening in 2023. Mike provided a real-time view into how market trends are shifting from the second half of 2022 into Q1, and how Altos data is starting to tell the narrative for how 2023 is going to play out in this spring home buying season. Now, as we jump to Odeta has the really challenging job of talking about mortgage rates and affordability.
So looking at the full history of the 30-year fixed rate mortgage, and I'm sure you're all familiar with this slide, so I won't spend too much time, but that more than 40-year tailwind has allowed for housing market turnover, cash out refinancing, and just a lot of turnover, obviously. Just you're able to buy that house, refinance a couple years later. And that's been the case up until, of course, we know that the most recent year when we've seen a pretty quick uptick in mortgage rates, still below the historical average, but very, very high relative to what it was. And that's kept existing homeowners rate locked in. It's obviously reduced affordability significantly for potential buyers. And just in the last couple of months have we seen mortgage rates start to come down as we start to see improvements in inflation. Now, it's notoriously difficult to forecast mortgage rates because they're tied to the wider economy, global geopolitical conditions, right? So every time I'm asked to forecast, I'm like, oh goodness, you've got to think about recession risk. You got to think about what's happening with inflation, what's happening abroad, if there's any wars, right? All of these things impact the long end of the yield curve. But with that said, here I'm looking at a couple of industry forecasts, and they're saying that we might end the year at 6%. I don't know the ins and outs of their methodology, but if they're thinking about it how I'm thinking about it, this is really kind of tracing out the path of inflation. The general expectation, the baseline case, is that inflation will continue to kind of come down towards the Fed's 2% target. And with that will come some normalization in the bond market as well. And you'll start to see mortgage rates sort of come down and stabilize. And so the industry average really is about ending the year at about 6%. Lisa mentioned kind of re-anchoring ourselves to a new normal. And I think she mentioned 6% is kind of the new normal. So that seems to be in line with industry expectations as well. Now, talking about affordability, oftentimes when we mention affordability, we're talking about prices. But here I'm showing the way I like to look at affordability, which is adjusting house prices, nominal house prices, by income and interest rates. So that's exactly what you're seeing here. House buying power, which is how much home you can afford to buy given income and interest rates, is in the blue line, and you can see that just fall off a cliff as mortgage rates have been increasing. But we're now starting to see prices sort of come down from the recent peaks. Incomes are continuing to go up. And so we did see in our latest November, December data that affordability is improving. Now, improving is relative. It's still down 60% from a year ago, but it is improving as mortgage rates are coming down, prices are adjusting down, and incomes remain going up, right? So if mortgage rates fall to 6% by the end of 2023, as industry forecasts predict, and let's assume household incomes are flat on an annual basis, and nominal house prices continue to kind of come down, then we should see affordability improve significantly by the end of the year, which should kind of pull buyers back into the market a little bit. So as mortgage rates sort of moderate from their late 2022 highs and house prices decline from their mid-2022 peak, nationally and across many top US markets, I think it's really helpful to sort of quantify the trade-off between mortgage rates and house prices. So I like to think of this as like a mortgage rate house price exchange rate. And when we do that, we actually find that a 1 percentage point decline in mortgage rates has about the same impact on affordability as an 11% decline in house prices. So using that analysis, you can kind of build out some simulations, right? You know, mortgage rate forecasts for 2023 kind of range from the high 5s to the low 6s. Annual house price growth forecasts range from -5% to 5%. So let's assume, you know, mortgage rates come down to 5.5% from, let's say, mid-6s, but house prices remain flat. Then we would see a situation where affordability would improve by 9%. So again, you can kind of play out these numbers a little bit to see what that exchange rate means for the affordability equation, at least on a national scale.
All right, now we're moving on to the man, the myth, the legend, Mr. Logan Mohtashami, HousingWire's lead analyst. Logan makes headlines with his bubble boy catchphrases and savagely unhealthy market calls, but we all know his work and analysis is deep and thoughtful. Today, Logan focuses in on global and macro indicators that are moving the housing market in 2023.
I'm going to basically go with my housing tracker. And I look at forward-looking purchase application data, what the 10-year yield is doing, what inventory is doing, and all the economic data around here. Housing changed back on November 9th. On October 27th, what I wrote for HousingWire was the case for mortgage rates to fall. On that day, the Fed's main recession indicator flashed a big red sign for them. The Federal Reserve is talking about closing out their rate hikes, which I believe is correct at this stage. The 10-year yield had shot up. The US dollar was strong. Markets were being chaotic. You know, Japan had to do intervention. London was worried about their pension funds. At that point, the 10-year yield started to fall noticeably. Forward-looking from November 9th, purchase applications internal data started to get better. It's kind of a funky data line. You have to do some seasonal adjustments and some weekly adjustments there. But from that point, looking 30 to 90 days out, the market should be better. And I stress to everyone, purchase application data had a waterfall dive in 2022. We took 7 years of growth and wiped it all out. So we are working from the lowest bar ever. So we've bounced since November 9th, and currently right now what we've seen is pending home sales are finally growing. We're seeing some active inventory possibly being taken away from the demands that were starting back in November and December. So right now we've stabilized, right? And where are we with the bond market right now? The 2023 forecast, I'm very technical with my work. The 10-year yield 4.25% to 3.21%. Mortgage rates 7.25% to 5.75%. We got all the way down to about 3.30 on the 10-year yield. That took us rates under 6% with the spreads wide. That was good enough to stabilize the housing market. So that's how we should look at it, stabilization. Now we are in the seasonal portion of purchase application data. The second week of January to the first week of May, after May, total volumes fall. We follow the weekly data to talk about the year. And because the bar is so low, right, stabilization is 6% good enough for the market to grow from here. That's what we'll find out. You know, we had a 25% weekly increase a few weeks ago, 3% last week was a 10% decline. Let the data, the forward-looking data, tell you how good it's going to be. Pending home sales is up, existing home sales will follow, but you got to follow purchase application data and the 10-year yield.
While Logan is starting to see some light at the end of the tunnel and positive indicators for the US economy and housing market, he has some concerns in areas that he's watching very closely, specifically weekly inventory in the 10-year yield.
I'm more worried that new listings data doesn't grow, right? Because what we saw last year is when rates got to 6.25%, new listings data started to decline earlier and faster than normal. That is a problem for housing, because when you think of the entire buyer profile, you got first-time home buyers, you got move-up buyers, move-down buyers, cash buyers, investors. You need that new listings data to grow for that seller to think, okay, I'm ready, good to go. I'm going to sell the house and then I'm going to buy another one. That's how traditional housing cycles work. That's how the housing market gets back to normal. When rates go from 3 to 7%, not a normal marketplace. So what we have to keep a track on, and this is why we created the Housing Weekly Tracker, keep an eye on the 10-year yield, keep an eye on economic data, keep an eye on weekly inventory, how it's going, as Mike shows us all the time each week. Bond market, where are rates going? But that forward-looking purchase application data has worked since the 1990s. It has never failed. And as of right now, still today, we formed the bottom, we bounced off that bottom. And what we have to look is every week, where does the rate level hit us on demand? Because bouncing off from this very low amount is not saying much. If we need the housing market to grow, we need purchase applications to grow because they look out 30 to 90 days. So as of November 9th, we started forming that bottom. Now we'll see. Do we need 5% mortgage rates to get more growth, or 6% means we're just going to hang around here for a few years until things get better? That's what the tracker is designed for every Monday.
All right, now we're moving to Geoff Green, who's the global head of mortgage and lending at Salesforce. Geoff takes a look at implications for lenders and how lenders are prioritizing initiatives and building their businesses in a market where volume has been more than cut in half. Geoff focuses in on operational efficiency, taking out costs, and how not to kill customer experience in an environment where costs really must come out of the equation.
I'm going to take a little bit of a different tact on, as Diego mentioned, on what are the implications for lenders? What are the implications for banks given the operational environment? Any comments that we make here at Salesforce before we say anything publicly, we always make a forward-looking statement, which is to make buying decisions on products that are generally available. But here's what we're seeing. Again, a previously maybe a $4 trillion market, neck down to maybe a $1.7 trillion market. What are the things that you're thinking about if you're in a lending shop to attack those opportunities to put people in homes and what it might mean for your operation? We sort of view it in three broad categories, which I'll speak to here. I'll double click from this a little further down. But the first one around operational efficiency, and let's say it again, because Salesforce is often viewed as the record of customer experience. There are loan origination systems and mortgage tech where the record of loan making exists. But when it comes to CX, when it comes to customer experience, you just simply have to make sure that in a lower volume market that you do not lose on customer experience, and ensuring that when a customer finds its way to you, either a net new one or someone who has a different product within your institution, if you happen to be a bank or a regional bank or something along those lines, that you can help get end-to-end on your internal systems to support that. And there are countless stories during the COVID boom where there might have been a great operational front end, a digitized front end, but the handoffs and where technology and people met just were not capable of pulling that through end to end. And the cost associated with getting that loan end to end was just not something that tends to be sustainable in an environment like this where you're fighting for every loan. So operational efficiency, cost takeout, and really thinking about how to do more with less and thinking about an end-to-end set of loan processes is absolutely paramount in this market. And in our install base with our customers, who we love dearly, we spend a lot of time with our customers on what it means to get end-to-end with efficiency and think about even end-to-end and beyond. And when I think about end-to-end and beyond, we talk about this a lot with our customers, this idea of where leads come from, where other lines of business within your institution might be fruitful for pulling somebody in for a mortgage product. These days of mortgage, or those days of mortgage being sort of out on an island, or that lending operation being disconnected from where the bank operates, or where those worlds might be on different systems, those days are over. Right now, cross-sell, upsell, contextual cross-sell, upsell, really thinking about where a customer and building customers for life come from is a key part of institution strategy during this downtime. As rates come back, as you heard far more brilliant people than me on this webinar talk about, this notion of, as we march forward, maybe a settling of rates where the new normal sets in, and that's what the business is going to look like. I would say also workforce productivity, we see it a lot. We need to make sure that in a space, this is my world, between lead management and borrower experience and where loans are processed and where they're serviced and where the opportunity to ensure that great customer service drives end to end. That's where you need the type of technology that helps you get from one end to beyond, and then think about what might be next. So all the KPIs that govern a world-class experience for your customers, as well as LOs and those who work in the organization who feel comfortable that they've got the right tech next to them for when the mortgage business pops again, that they're ready to take on the volume and really delight customers with excellence.
Okay, now that we've had commentary from each of the panelists that took part in the HousingWire housing market update, we're moving into kind of a wrap-up session. And the moderator for the housing market update webinar on Monday, Diego Sanchez, asked each of the economists and guests for the webinar how they would kind of put a label on 2023. And most of us know, and most of the housing news audience remembers, that Logan coined the phrase savagely unhealthy for 2022. Now, each of our panelists has the opportunity to share their unique perspective and kind of put a label on what they expect in 2023. So we're going to spotlight the key themes from Mike, Odeta, Geoff, Lisa, and Logan, starting with Mike right now.
First-time homebuyers have been having a really tough time in the past several years because, overbidding and cash buyers and all the things. And in a higher rate environment, they are not as sensitive to selling the last place and moving into a new mortgage. And we have fewer bidding wars and more inventory. So maybe it's finally an opportunity for first-time home buyers in 2023.
I had one in mind, rebalancing, right? I know Lisa said resetting, but really a rebalancing of the housing market, a readjustment to make homes more affordable. Prices or rates may stabilize. I think in a lot of areas, prices will continue to need to kind of come down from the peak to adjust to a new normal. So I will say that my word for 2023 is a rebalancing of the housing market.
In terms of with the pause and with the ability to, you can't come up with all that money or decide to make a move and then have pain in that process. Like, you're talking about the macro factors. This has been an amazing conversation about what it takes to get to that starting block when inventory and rates and the opportunity is there. And then on the other side, it's just got to work for people end to end all the way through. And I think this is the year where customer experience can really be a story for what it's like to get a mortgage, to live. First-time home buyers, by the way, and the most veteran of veteran, because it is scary as heck to be a first-time home buyer and try to go through that process. And there should be no difference. There should be no difference in any composition of what that borrower looks like. And so I think this could be the year of CX, maybe a level playing field of CX that knows no boundaries. So there, I said it on the other side of all of this.
I'll just jump in, and I really think maybe in addition to that rebounding or resetting, I think it's all about local and it's all about forward looking, right? So we spent a couple of years sort of talking about a national housing market. We've been comfortable looking at last month to predict next month, but all the data that Michael presented and the weekly dashboard that Logan's talking about, more important than ever that you're getting your data very timely. You're getting the most accurate data for your local market, which, we'd like to say is your local MLS. So where the most accurate data are, but really, I think it is also another chance sort of picking up a little bit on the customer service angle. Is this is a chance for real estate professionals to shine and to really show their value, right? We had a couple of years where, yes, real estate agents and lenders were working their tails off, but there wasn't enough time really to demonstrate the level of expertise and knowledge that they bring to the transaction. And it's going to be more important than ever for those real estate professionals to demonstrate value with forward-looking local data on the housing market to help move buyers and sellers into the right decision.
Unhealthy market to the savagely unhealthy market, the forbearance crash bros to what we are in right now. Eventually, the foreclosure fanatics will come back. So the labor market is still too solid for them to really start to get too loud, but slow dance. Housing slow dance is perfectly fine. Days on market growing up slowly, inventory rising, get things back to normal, right? We have not had a normal housing market post 2020, and there's nothing wrong with that, right? So this is why we should embrace inventory gains, embrace days on market getting higher, get back to what we used to have during the longest economic and job expansion ever recorded in history before COVID-19 hit us. We had millions and millions of people buy homes. Price growth weren't running insane back then. So we're going to get back to that level. So a housing slow dance is the best thing for 2023.
Okay, folks, that's the final word. The housing market slow dance, or the great resetting, or the year of CX, or the year of the first-time home buyer. Maybe we'll get lucky and see all of these themes play out at once. Maybe not. Thank you for tuning in.